Chapter 10, the birth of a new asset class. For centuries, the financial world operated within a familiar structure. Assets were divided into equities, bonds, commodities, currencies, and real estate. Every investment, every market, and every flow of capital fit neatly into one of these boxes. Until Bitcoin. It did not behave like a stock. It did not behave like a currency. It did not behave like a traditional commodity. The data refused to place it inside the old categories. This series has proven that Bitcoin is something new. A new asset class has been born: digital commodities. The verdict is built on evidence, not on a single headline or one market cycle. We demonstrated a great rotation of capital away from a decaying equity structure and toward a strengthening Bitcoin market during macro stress. We quantified the decoupling with the sovereignty ratio. Bitcoin's relationship with the Nasdaq inverted while its relationship with its own fundamentals strengthened. This showed that Bitcoin was developing sovereign market behavior. The sovereignty ratio transformed the idea of independence into a measurable classification signal. Bitcoin was no longer simply a satellite of the risk market. We showed why rotating capital chose Bitcoin over gold. Gold cycle had entered distribution, while Bitcoin attracted stronger underlying demand force. Gold remains valuable, but a new safe haven was emerging. We established that Bitcoin meets and exceeds the classical criteria for a commodity: fungibility, absolute scarcity, a transparent inventory system, and clear demand cycles. We then built the real value protocol, a dual model system that provides a quantifiable range based on speculative energy and fundamental utility. Value became something to measure, not merely debate. The value floor measures demand energy. The value ceiling measures network health. Together, they anchor a digital commodity to its function and its current condition. Finally, the Scarcity Momentum Index explained explosive movement. High scarcity alone is not enough. A supply shock appears when scarcity collides with high and accelerating demand. Bitcoin's volatility became a measurable economic engine. Digital commodities merged the scarcity of physical commodities with the utility and speed of digital networks. They are defined by scarcity, monetary utility, network demand, transparent inventory, and programmable economic behavior. Bitcoin is the monetary commodity. Ethereum is the computational commodity. XRP is the liquidity commodity. They are the first leaders of this new asset class, but they will not be the last. Just as finance moved from gold coins to paper money and from paper money to electronic banking, the world is now moving toward digital commodities. Bitcoin is the spark, Ethereum is the engine, and XRP is the bridge. The digital commodity thesis is not a prediction. It is a measurement, a classification, and a declaration backed by an overwhelming body of evidence. A new asset class has been born and digital commodities are here. A new asset class has been born. Digital commodities are here. The essential compass is no longer the old market language. It is an understanding of function, scarcity, demand, and structure. To recap, the evidence shows rotation, independence, commodity properties, measurable value, and quantifiable supply shocks. In video 11, we explore the birth of this asset class in the broader history of finance. This conversation is for educational purposes only and not financial advice. Past performance does not guarantee future results, and investing involves risk. This is an invitation to learn, not a recommendation to invest.